Hello, everyone. I hope you're doing well. Welcome to today's class on the basics of capital budgeting. Generally speaking, managers in any company are always looking for projects that can add value to a firm's value. So, in general, there is especially in companies, there's a corporate finance department. And this corporate finance department is always kind of looking for projects that can really help the company, add value to the company. And generally speaking, they're not looking at tiny projects, they're looking at rather large projects. And those projects, many times, can actually redefine the entire strategic direction of a company. Generally speaking, if companies do decide to take one of the projects that, let's say, the corporate finance department is evaluating, it is usually a long-term decision, and therefore it reduces the flexibility that a firm has. Now, what happens is that whenever there are projects that a company can sort of invest in, it is very important that there is a very in-depth screening process where companies really look at and evaluate the proposals from all different angles before they actually accept taking on the project. How companies evaluate the projects this is done in 6 different ways that we will be discussing in today's lecture. And this is specifically more so for, something that corporate finance departments focus on in companies. And what are those 6 different methods? Well, there's the net present value method, the internal rate of return. These two you've heard about. But there's some new ones, such as the modified internal rate of return, the profitability index, payback, and discounted payback. One thing to mention is that in all of these methods that companies use, it is assumed that cash flows occur at the end of any period. So the first method I'm going to talk to you about is the net present value method. Okay, and again, what are we trying to do? This is just a way to sort of evaluate a project, right? That's what we're talking about. Now, the formula for net present value is given right over here. And as you all know, it's basically discount each of the cash flows by the, this R value, the return value, right? And so basically, according to the present value, if you want to use this NPV method, the first thing you need to do is you find the present value of each cash flow, including the initial cash flow, and you always discount the projects at the cost of capital, which is this R that I just mentioned a second ago, right? In this formula, right over here, right? These are, so again, this is the cost of capital. And then at the end, what you do is once you discount each of those cash flows, you add them all up. And the sum of the discounted cash flows, that is what your NPV or your net present value is. And again, the formula is given for your reference. Cash outflows are treated as negative cash flows. And generally speaking, there is, a cash outflow right in the beginning. Now, one thing that's very important in this chapter that I want to really point out right at the beginning is that there is a terminology of either mutually exclusive projects or independent projects. And it's very, very important for you to understand the difference between both of these. So if two projects are mutually exclusive, that basically means that if one project is taken, then the other project must be rejected. You can only choose one out of the two different projects if they are mutually exclusive. And you always are going to want to choose the one with the higher NPV, okay? But then there's another terminology, which is independent projects. And in this specific case, you don't need to, it's not like you have to choose one or the other. In fact, cash flows are independent of one another. And in this case, you usually, companies will want to take on and accept any independent project that has a positive, net present value. Now, if there is a project that has an NPV or net present value of 0, this basically means that the project's cash flows are sufficient to repay the invested capital and provide the required rate of return on the capital. So it's good enough. I mean, there's no money, extra money coming in by taking on the project, but if you take on the project, then you will be able to pay off any money that you really take on to fund the project. So it's kind of a, zero kind of balance situation. However, if their NPV or the net present value is positive, then that basically means that if you take on the project, then more cash is going to be generated than is needed for you to service the debt or to pay off the debt and provide the required return to shareholders and access cash accrues to shareholders. So basically, you will be making money if the NPV is positive. If the NPV is 0, it's sort of like you'll be making as much money as you'll be paying out. So it's a 0 end balance. Obviously, if it's a NPV, a negative NPV, then you're going to be losing money if you invest in that particular project, and you don't want to invest in any project that has a negative net present value. The next way to really evaluate different projects is by using the internal rate of return. And the internal rate of return is the discount rate that forces the net present value to equal 0. And just for your reference, on the top right hand side, the formula for IRR is shown right over there. In overall, it is it's very difficult to sort of calculate the IRR because it needs a lot of trial and error. So generally speaking, you want to use either Excel or a financial calculator to calculate IRR. Now, if there is you are given a cost of capital or a hurdle rate, this new hurdle rate is a new terminology, but it is pretty much the cost of capital. If the IRR that you have is higher than your cost of capital, then that is a very good situation, okay? And you want to accept the project. On the other hand, if the IRR is lower than your cost of capital, then you will not want to accept the project. Mathematically, both net present value and the internal rate of return will give you the same decision whether you want to accept or reject a project if they are independent projects. But if you are thinking about, choosing between mutually exclusive projects, then IRR and NPV may give you some conflicting decisions. Maybe the NPV says, okay, take this project, but according to IRR, you should not take the project. So there may be some conflicts if you're choosing between two projects. But if you're choosing between independent projects, then NPV and IRR will give you both the same accept or reject decisions. Positive IRR projects will always increase a shareholder's wealth. So if you have positive IRRs and they are higher than the cost of capital or the hurdle rate, then that is a very, very good situation. So if somebody was to compare the net present value and the IRR method, then what would one say? Which one is better? Well, generally speaking, the NPV method or the net present value method is supposed to be better than the IRR method. Now, next, I'm going to talk to you a little bit about evaluating mutually exclusive projects. And a lot of the practice problems in this chapter are all going to be where you have two projects that are given and you have to choose, one versus the other based on, NPV, IRR, MIRR, etc. So again, when I'm talking about mutually exclusive, that means you need to choose one or the other project. You can't choose both. Now, if the IRR is greater than the cost of capital or the hurdle rate, then IRR and NPV both will rank one project, the same one, higher than the other, and there will be no conflict. Now, as a rule, when you are evaluating mutually exclusive projects that differ in timing or scale, then always use the NPV method. So sometimes there's going to be some projects that are longer, some shorter, some are very big, some are very small. If you are trying to sort of figure out, choose one or the other in such situations, always use the NPV method as compared to the IRR method. And I'll talk to you a little bit about why that is the case. Because again, there are different conflicts that sometimes come up with IRRs, and I'll talk to you about that right now. So here in this, here you see a situation that is going on where there are multiple IRRs. There is a project that has two IRRs. How can that be? Well, normal cash flows are generally what happens when there is one or more cash outflow, and then there are a bunch of cash inflows. But sometimes there's a non-normal cash flow situation. And in that situation, what happens is that there's a cash flow, maybe outflow in the beginning, then there's some inflows, and then there may be some cash outflows again. That is a non-normal cash flow situation. And when that happens, then that can result in multiple IRRs. And therefore, in such situations, it is better to use the NPV method. All right, next I'm going to talk to you about, MIRRs, or the modified internal rate of return. Now, this modified rate of return, the formula is given right on the top right-hand side for your information. MIRR is the discount rate that forces the present value of the terminal value to equal the present value of costs. And again, to calculate the MIRR, I highly recommend you use Excel. And if you use the MIRR functionality, then you basically say, plus MIRR brackets, you add the cash flows, the cost of capital, the rate used to compound inflows, and you close the brackets. Now, IRR generally assumes that cash flows are being reinvested at the project's internal rate of return. But the good thing about MIRR is that this assumes that cash flows are being reinvested at the project's cost of capital, and that is a much better situation. If projects in general are of the same size and life, then both the net present value and MIRR will always give the same decision when choosing between mutually exclusive projects. Next, I'm going to talk to you about, evaluating projects based on profitability index. And here you can sort of see the formula of what how to calculate the profitability index. And here what you can see is basically they are taking the present value of all the cash flows and dividing it by the initial cost of the project. If the profitability index is greater than 1, then generally the project is acceptable. Higher profitability indexes lead to higher projects rankings. One thing to remember is that profitability index, MIRR, internal rate of return, NPV will give the same results for all independent projects, but there may give some conflicting results for mutually exclusive projects. Okay, next I'm going to talk to you about payback method. And payback method basically helps calculate the number of years required to recover the original investment that has been made for the project. Now, there are the formula for this is right over here on the top. You can see this is the unrecovered cost at the start of the year. This is the full formula is the number of years prior to full recovery plus the unrecovered cost at the start of the year divided by cash flow during the full recovery year. Now, the payback method has some flaws. The first flaw is that the money received in different years are given the same weight. So there's no time value of money when you're calculating the payback method. This is a flaw of in the payback method. Also, cash flows beyond the payback year are given no consideration. The third drawback is that this method doesn't explain if the project will increase the shareholders' wealth. Therefore, another method has been sort of devised, which is the discounted payback period method. And here, this is the same as the payback period, but in this particular situation, expected cash flows are discounted by the project's cost of capital. Therefore, the discounted payback period is the number of years required to recover the investment from the discounted cash flows, right? And I'm going to show you an example of all of this in just a second. This method now also does take into account the time value of cash flows. In general, short payback projects indicate higher liquidity, so they're kind of good because you'll be getting your money back very quick. And payback periods that are very long and you're expected to get money like after a very long period of time, well, that indicates risk, and therefore payback periods also give a good indication of a project's risk. So here we see, $10,000 has been invested in the beginning over here. And when you're calculating the payback period, you're kind of seeing, okay, well, 5,300 is going to be recovered in the first year. Then 4,390 is going to be, going to be recovered in the next year. So that is 9,700, but there's also going to be a certain amount of money that was also going to be recovered in the third year. And so you take the remaining balance and you divide that by 1,874, and that would give you the payback if you're just using the normal payback period. But if you're using the discounted payback period, the difference is that each one of these cash flows, the regular cash flows, these are discounted, right? And so this right over here, these are the discounted cash flows. And then you sort of use the similar method of seeing, okay, the $10,000, how many years is it going to take for you to recover? And that is going to give you an answer that's going to be a little bit different than the normal payback period. So again, if you're feeling slightly overwhelmed with this, I wouldn't worry, because once you actually do the practice questions, you will understand, and it will be easy for you to calculate these. So I now want to talk to you a little bit about, all of these various methods. I kind of just discussed and explained 6 of them to you, right? The NPV method, IRR, MIRR, profitability index, payback method, the discounted payback method. So let's sort of look at these on a strategic level and see, what are we learning from each one of these? Well, the first one, NPV, this shows basically the profitability, and it shows the monetary benefit of taking on a project for any shareholder. The IRR also shows the profitability, but it shows it in percentage terms. MIRR incorporates a better reinvestment rate as compared to IRR, right? Because remember, IRR assumes that money is being reinvested at IRR, whereas MIRR assumes that it's going to be reinvested at the cost of capital. And so this MIRR also avoids the multiple rate of return problem. Profitability index, this measures the profitability relative to the cost of a project, and it also gives a good indication of the project risk. Both the payback and the discounted payback indicate liquidity and risk of a project. And also quantitative methods should be one thing to really remember, is that look, up till now, these are all quantitative methods. We've discussed 6 of them, but it's also, you shouldn't just blindly follow the quantitative method, the results from the quantitative methods. Qualitative information should also be taken into account. And generally speaking, when managers are making decisions, they should use both the qualitative and quantitative information to make very informed decisions as to which projects they would like to invest in and which ones they would not like to invest in. One thing to remember is that in a perfectly competitive world, all projects would have a zero NPV. They would have an absolutely zero NPV because it would be perfect competition. But if there are any projects that have a positive NPV, that means that those particular projects have, if you take them on, they have some sort of a competitive advantage. Now, if that is there is a project that has a positive NPV, that means that generally speaking, there must have been a lot of hard work to develop some sort of a competitive advantage. However, if you've calculated a positive NPV, but you can't really figure out why there is, what the competitive advantage this particular project brings with it, or what are they doing differently, but it's still showing a positive NPV, well, probably in actuality, it's not going to have a actual positive NPV. It may be showing up in the calculations, but it's not really going to be a positive NPV project, because you can't really tell if, what the competitive advantage is. Also, finally, even if there is a competitive advantage, it's always important to remember how long that competitive advantage will last. If there is a patent, or there are some laws or some high entry costs, then there's a high possibility that those competitive advantages will last for a long time. But if the barriers to entry are relatively low, then it's possible that the competitive advantage won't last very long. Generally speaking, NPV is the best single criteria, but other methods also give very useful information. Now, there are some special applications of cash flow evaluation. So sometimes there are going to be projects that you have to compare that have unequal lives. So let's say there's one project that is of 3 years, and then there's another project that's of 6 years. Well, how can you really compare these? In that particular situation, what you do is you create a replacement chain, or you use the common life approach, and you try to make them the same time period. So let's say you are comparing project C with project F. C is a 6-year project and project F is just of 3 years. Well, what you do is you double this up. So you take project F, you take exactly these cash flows over here, and you just presume that this project is going to happen twice. And so you take these cash flows, and in 3rd year, you say, okay, the project will start again. And then you sort of find all the cash flows, the summation of the cash flows. And then you compare these cash flows and the NPV and calculate all the different, evaluation methods, and you compare it with the project C's cash flows and evaluate, and then you evaluate these two projects. So this whole idea of trying to create this replacement chain and common life approach, this initially started with electrical engineers, and this is when they had to choose between designing power plants and distribution plants. Some of them, they had lower initial costs, but they had shorter lives, and other project plants and distribution lines had higher initial costs, but then they had longer lives. So again, this is, how this is when this question came, okay, well, how do you compare these two situations? So so one way is you can double it up, but you can see over here, this would work if, one is 3 years and the other is 6 years, but sometimes that's not the situation. So another thing that a lot of these engineers realized that they could do is to really calculate, to convert the annual cash flows under alternate investments into constant cash flow stream, where the NPV is equal to the original stream. So So this was yet another method that can be used where basically the cash flows, these uneven cash flows, right? These were taken and they were converted into equivalent annuities. So that's another way that can be used to sort of, calculate the difference. And again, you already know how to calculate the equivalent annuities. We've covered that in the time value of money chapter. So that's another thing that can be done to sort of evaluate these cash flows, right? And sorry, to evaluate different projects. One thing, a couple things to really remember when you are really evaluating mutually exclusive projects. Number one is that there may be inflation, and if there is inflation, then future replacement costs may be higher. Future replacements may change cash flows. So in the future, if you replace a machine, not necessarily that exact cash flows will result. There may be some changes because maybe the machine is also going to be different at a later on in the future. And it's also not also difficult to estimate lives of most projects and lives of a series of projects. So generally speaking, there is a little bit of problem when you are trying to, really evaluate projects with significantly different lives, right? One is very, very short, one is very, very long. So that's very important. Next, I want to talk to you about something interesting, which is the physical life versus the economic life of a project. So sometimes, a physical life of, let's say, a machine maybe of 20 years, but the economic life may be different. And what is the economic life? Well, the economic life is the life that will maximize the net present value and the shareholders' wealth, and this may be different than the physical life. So you may have to, there may be a situation where it's better to stop the project or to stop using a particular machine before the end of its entire life. And again, this is something that there's going to be a question or two on this in your assignment where you will learn about the difference. But it's important for you to bring this up in the discussion. All right. Next, I want to talk to you about optimal capital budgets. And the optimal capital budget is a set of projects that maximizes the value of a firm. So generally speaking, let's say you're in a corporate finance department, there may be about 7-8 projects that, come up on your table all of a sudden, and each one of them has a positive NPV. They seem to be really good. So according to theory, financial theory, you should accept all of them and you should start working on all of them. But in reality, this is something that doesn't always happen. And the reason is a couple of reasons. There are two particular reasons that I want to point out. The first one is increasing marginal cost of capital. So if you go into the market and you want to get like extra money to fund these projects, well, the cost of capital may be very quickly increasing. So this may be, a deterrent or to take on new projects. Also, there is something that companies do, which is called capital rationing. And this is where companies really try to limit the amount of capital expenditures that they are making, because maybe they are reluctant to issue new debt, or there are constraints on non-monetary resources such as marketing and finance and all the support departments. Maybe they don't have capacity to take on a lot of new projects. And finally, some companies think that, look, a lot of people, corporate finance departments, others, they inflate the future cash flows. So they say, you know what, when you're calculating making any analysis, then you use a very high cost of capital. And that's because of that, then very few projects seem viable and companies don't take on a lot of projects. So that's something very important kind of to mention. And with that, I come to an end of this chapter. And I hope you enjoyed it. I hope you enjoy doing a lot of the questions. I definitely did. It's always fun to sort of evaluate various projects. And, I look forward to discussing more with you in class. Thank you.